Good evening. This is Ken Long from Tortoise Capital Management with a review of the weekly trading plan for January 22nd, 2011. And we begin. We start off with the market in bullish normal conditions after about 6 weeks of bullish quiet. Bullish normal is still favorable on an average basis, but not as favorable as bullish quiet. So the increased volatility we've seen in January is starting to have an effect. On an annual basis, the market is back down to the high end of neutral on the weekly RSI at 70. The 10-day index has the market in the upper half of normal on a short-term basis. The percent stretch above the 200-day moving average and the slope of the 50-day moving average are both bullish, both exceptionally strong, and that's favorable. ADX has pulled down from north of 35 to 33.5. It's still favorable, but the decline is showing some weakness entering the bullish market. The ATR percentage at 0.88 is still at the boundary low end of normal, but it has almost doubled since hitting a low around 0.5%. U.S. performance has begun to lag the rest of the world. As when we look at the world market model, we'll see that. We'll see that some of the Euro countries have turned in exceptional weeks, especially Spain is off the chart. Precious metals have pulled back. They're still above the 200-day moving average, and they're becoming attractive after a significant pullback. Energy is still the dominant global sector. U.S. financials and U.S. technology are still strong, as is agriculture, which is benefiting from rise of food prices. India is on my short list as a maximum pain for stocking. It's been hammered more than any of the other large economies, and so it's a natural place for value seekers to be looking. Natural gas had found support around 5.5, is north of 6, and is continuing to make gains with symbol UNG. Monthly and quarterly rebalancing, there's no change until about 1 February and 1 April, respectively. In the ETF2 system, our theoretical exposure is reduced to 90%. The model portfolio will be at 90%. There are 3 positions that must be sold by rule: the small cap growth, coal, and metals and mining. And then in order to get back to the 90% model portfolio, there will be 2 positions added: the second position in DBA, which is the agricultural ETF, and XLE, the U.S. energy sector spider. In the global health check, you can see we're looking at 10, 20, and 30 days for our short-term market look. The red lines are the places where prices previously formed support and resistance. We are in bullish normal conditions. The ADX, you can see, has rolled over from 35 and is back to right around 33.5. The channel for the 30-day regression line is still very narrow, and the slope is still positive. So we've had this little pull back and test here back to the 20-day moving average. So price now closed just above the 20-day moving average. That's favorable. And 20 is better than the 50, and the 50 is better than the 200, which is not even on the chart yet. And so that's still a favorable bullish normal conditions, but one in which we are respecting our stops and not counting on this extraordinarily powerful bull quiet to continue. You can see on Williams percent R10 that we've pulled back into the middle range of neutral, and on an annual basis we are still well oversold. Overbought. From the ETF2 report, looking at the top 10 indexes of the world, you see the U.S. has definitely pulled back into the pack. We still have some strength in technology and the large caps, but the small caps have inverted. Instead of being the strongest U.S. sector, they're now the weakest. So that has been a inversion from the end of the year. Europe and Asia have started to pull back. Right now, the greatest weakness is in Latin America and emerging markets, selected emerging markets. 9 of the 10 indexes are positive on a 5-week rate of return, which puts us at a model exposure of 90% invested, 10% cash. Only the mid caps now are overbought on a weekly RSI basis. In the extended world market model, you can see that the semiconductors and blended commodities are still doing very well. Oil and gold have been suffering lately. Oil may be in a position for a value trade here. In the sector spiders, industrials and energy are doing very well. Financials are not bad. Weakness still in the defensive sectors like healthcare, utilities, and staples, although they have made a considerable comeback this past week while the small caps were cooling off. We see those same trends in the global business sectors as well. In the world market model integrated, you can see that the areas that used to be green are now yellow inside the U.S. sector. So the small caps and the growth area are suffering. Oil, gold, silver, and treasuries all in the red, so that becomes a value opportunity in my opinion. India went from 0 to 1. It's still the Max Payne candidate for all of the country funds. Europe did well in some bond market sales this week, and that I attribute that to the success we're seeing in Europe. Their fundamental economic issues remain challenging, however. Most of the U.S., except for real estate and pharmaceuticals, are on a buy in the 100 by 200 crossover system. Nothing short. And you can see the pullback has put gold into a hold position there. Top 30 ETFs, looking at all the usual suspects. Agriculture at the top 3. Energy, Malaysia, sector, the Taiwan, oil and gas, again seeing the domination there by agriculture, commodities, energy, and selected Asian countries. The top 25 liquid ETFs remain the usual suspects. Again, Brazil, oil service, gold miners, and oil are the intraday most volatile, with the diamonds naturally being most exceptionally quiet. And those are, again, the top 25 candidates for intraday trading based on liquidity and volatility. Inside the ETF2, taking a look at the model portfolio. We will be selling coal, metals and mining, and U.S. small cap growth by rule. They are either negative on the 5-week rate of return, as you can see here and here, or they are below average on the strength rating. We will be adding XLE, which is the energy sector spider, and buying a second position in DBA agriculture, which is doing pretty well. In fact, I guess, yes, that's the leading net gainer for the year in that portfolio. And that's the weekend market report, review of the weekend strategy report for ETF2 and beyond. Thanks for your attention and good trading.